Joining me now, Yardeni Research President and Chief Investment Strategist, Ed Yardeni. Ed, there's a lot to unpack here, right?
Absolutely.
So it's obvious this week, inflation, oil prices, Iran have superseded earnings. It's overshadowed earnings. And now Wall Street, today's session kind of suggests that Wall Street thinks it's at a threshold that the White House has blinked before. What do you think?
Well, I think when you look at the market objectively, we've been in a summer stall since May 14th. That's when we got to 7,500. And here we are still fluctuating around 7,500. So what I think is really going on is we have a very, very bullish environment on the earnings side. On the other hand, people are focusing on some of the issues that might threaten that down the road. And one of them is, as you said, is hyperscalers spending all this money. Will it contribute to earnings down the road? But for here and now, earnings are very strong. But between what's going on in the Middle East, higher inflation, and the Fed tightening, those are offset. So I think we just stall out here through the end of the summer, and then we look at things objectively again, and I think things will be pretty good.
So part of this is just sort of a seasonality script then?
Well, I don't.
The so-called summer swoon, or the lazy days of summer.
It's the lazy days of summer right now, I think. But from a fundamental perspective, there's kind of an important tug of war going on between the bulls and the bears. And the bullish story is very compelling on the earnings side, and the bear story is logical when you see what's going on in the Middle East, oil, and the possible Fed tightening.
What's interesting to me is on that note, I saw a great headline today. I was looking for something else, but it was when the Dow fell 508 points, $500 billion loss. It was the San Francisco Chronicle. But at the top, the biggest headline in that paper that day was U.S. ship destroy Iran outpost. Right. So this interlocking thing with Iran, this is not new, and it seems
new.
And it impacts our markets over and over again.
Yeah. Well, it doesn't. It doesn't. Again, I think the market's kind of acting very rationally and just waiting to assess things. And while it's waiting, I think what investors are doing is they're lightening up on companies they just don't really understand, like the hyperscalers, and getting into companies they do understand, like transportation stocks, biotech companies. They don't necessarily understand them, but at least you know what business they're in.
Right, and you know that there's a patent cliff and that they're going to be taken over.
Known knowns.
Right.
With the hyperscalers, you get a lot of known unknowns.
Well, to that point, when all I focused on Google this week, Alphabet, was that cloud revenue. 82%, profit margins from 20 to 36%. That to me should have not necessarily completely assuaged all of the anxiety out there, but mitigated it a little bit.
Well, some of these hyperscalers like Google are going to be sort of like Rodney Dangerfield. Remember that comedian? He kept saying, "I don't get any respect."
Yeah.
They don't get any respect because they just focus on the negative free cash flow, which is not a big deal. I mean, if they decide to slow down the capital spending, everybody thinks that's going to be a bear market.
That's the crazy thing.
But the profits actually go up.
There's no win or no lose in this situation. By the way, there was a great poster when I was a kid. Rodney Dangerfield, one of these beer companies. It was like tastes great, less filling. He was on both sides. They had. So I want to ask you about the financing part of this, because that's the other issue when it comes to the AI build out. Adam Taggart today had a post that the bond vigilantes are starting to revolt in the AI corporate credit market. And you coined the term. Are you saying that?
Yeah, I think to a certain extent that's the case. The bond market is being challenged by lots of demand for financing by these hyperscalers, and I think the bond market's kind of pushing back and saying, maybe you ought to look elsewhere for funding. Maybe you ought to look at raising more equity. But I think it's a legitimate concern.
So next week is a biggie. Earnings is even more important than this week.
Yep.
Is there any particular name that stands out to you for next week that might change the narrative here?
Well, I think we've kind of had it with Google. I mean, Google kind of set the stage, so we're probably going to get more of these hyperscalers.
So more increased spending. It shouldn't be.
Yeah. But again, this should already be discounted in the market. And as you said, right now we have rotations going back into software and out of semiconductors. I think a lot of this just kind of trading activity that at the end of the day isn't going to affect the overall market, and the overall market is still a bull market.
So you have the highest number on the street for the
Yeah, 8,250.
8,250. You feel pretty. You still feel pretty good about that.
Yeah, you know, when it comes to earnings, I haven't been bullish enough.
Right.
I think what the analysts, what the market discounts is not my expectations for earnings. It discounts what analysts think. I mean, that's why we pay them.
Right.
And the analyst consensus is up over $400 a share for next year. So if that's still the number by the end of the year, put a 20 multiple on it, you got 8,000. But the earnings are already continuing to move higher here for all the angst about all the sort of the fine details of hyperscaler spending.
It's amazing. We blew away the first quarter. We're on the verge of blowing away the second quarter. And to your point, it's still a sword of Damocles. It's like, when does it end? But ultimately, markets somehow find a way to trade through that. And if you're not paying attention, you'll look up one day and say, gosh, we're at a new high.
As long as this doesn't cause a recession, I think the market keeps going higher.
Great stuff.
Yeah.
Have a great weekend, Ed.
You too.
Appreciate you, man.